Matthew Peterson is the managing partner of Peterson Capital Management, which he founded in 2011. He has worked with Goldman Sachs, Morgan Stanley, Merrill Lynch, American Express, and Ameriprise Financial all over the world. He now manages a long-term concentrated value-based fund with a very impressive track record that exceeds 15% over a decade. He will speak about that tonight. And it's been a pleasure to watch his fund's success and frankly, how much he contributes to the value investing community. So Matthew, welcome, and I send it over to you.
Thank you, Danielle. Thank you very much for being here, Danielle. We absolutely love having you moderate this for us. Welcome, everyone, to the Peterson Capital Management annual meeting. As Danielle mentioned, this fund was established over a decade ago, and it's a pleasure to have so many esteemed partners involved. Today, I expect we'll have participants from at least 25 states and 11 countries, with some of them in quite inconvenient time zones. So I appreciate you all being here. It is a great pleasure to have you all involved. This compounding machine that we have built is well on its way. Our process is noteworthy. Our forward-looking potential is significant, and I very much look forward to many more decades with all of you. Today, we have another year of great news to discuss, and I will share some very lucrative secrets, but mostly we want to take a chance to get to your questions and answer everything that's on your mind. So that is why we will briefly discuss fund performance, provide you with an update on several wealth building compounders from the portfolio, and then share impressive details on portfolio software that we have built in-house to execute a repeatable strategy that will add meaningfully to the future performance. Following my remarks, we will also hear from a very special guest, Professor of Computer Science, Dr. Siddharth Krishnan from the University of North Carolina in Charlotte. He is going to speak regarding the remarkable work that they've been doing with a team of students and interns. We will then move into the Q&A portion of the meeting, where we'll address all of the questions on your mind. So we have a lot to cover and many new partners at the meeting. So that is why we should just begin with our mission statement. Our mission is to provide a world-class capital allocation vehicle that builds enormous wealth for our long-term partners. And as I will show you, our research and portfolio is receiving significant new attention, and we are continuously making progress toward achieving this very ambitious goal. This performance graph reflects returns into last week. Portfolio is illustrated in dark blue, and although the returns are not linear, they have been highly satisfactory as expected over the long term. 1 million in our fund has grown to 5.2 million. We are currently about 13% ahead of the S&P 500, which would be at 4.6 million, and nearly triple the value of the hedge fund index average. Our performance is admirable because it's extremely difficult and rare for investors to outperform the S&P 500 for a single year. Each year, only around 20% of professionals beat the index. And over a few years, this advantage falls to just a few percent of funds globally that are able to continue to outperform. But we're not strongly correlated with the S&P 500. We use it as a benchmark because it's most partners' best alternative to our fund. During the first decade of the fund, the S&P index broke historical performance records that are unlikely to continue. The businesses we own, however, don't share the same fate, and thus we see potential to further differentiate our performance as the markets are pulled toward their multi-century average 6.8% plus inflation. So this is the very beginning for us. As I shared last year, because of our distinct portfolio management process and the muted long-term expected performance from the market, we anticipate that our outperformance can accelerate in the quarters and years to come. This chart shows our returns versus the S&P 500 for each fiscal year, and our annualized returns at the bottom of 15% versus the 13.9% for the S&P 500. And you can clearly see that the returns are not linear, and we don't expect them to be. we own a very small number of high quality businesses that have tremendous growth potential in the years to come. This is the proper approach to diversification. Our strict concentration subjects us to short-term price fluctuations resulting from noise that is not representative of the long-term business growth and the performance trend. So it's worth noting that great fund managers evolve and improve as they gain knowledge and experience. And we've achieved this market-beating return over more than a decade, which is impressive, but I'm a better investor than I've been at any point in the past. This knowledge and experience makes us far more likely to continue to succeed in achieving outperformance, and that bodes well for the future of the fund. So our portfolio today truly has enormous potential, and it was and it still is remarkably oversold when we reported last quarter. Several holdings like Seritage, HanesBrands, and Daily Journal, which together make up about 50% of the fund, trade currently below their liquidation value. And others like Berkshire are among the highest quality assets in the world, selling for far below their rapidly growing intrinsic value. So in just the first half of Q3, shares of HanesBrands are up 50%. Seritage is up 100%. And both firms can go up 100% or more from here in the short term. With a concentrated portfolio, these gains have pulled the fund up over 25% in just a few weeks. And we're now down less than 5% for the year against a decline of about 11% for the S&P 500. So during times of uncertainty, which causes volatility in the markets, we are still certain because we've done the work and we understand the upward trajectory of the businesses. In fact, we're more likely to gain an advantage and widen our outperformance during these uncertain times. So we expect our continued returns to be lumpy, but while some lesser experienced investors wait nervously for the market to move up before they're ready to buy, you all will find it is advantageous to be adding capital to the fund while the markets struggle. So we've discussed in the past some of our alpha producing components of the process. And we've actually discussed this extensively, written about it in letters. We have videos online, and we've posted a lot of videos that are available on our YouTube channel. But in summary, the point I want to make here is that we can only control the process, not the price outcome at a moment in time. So we focus on executing a dominant process that will lead us on average to a market-beating outcome. And we follow this proprietary four-step process. We start with a 13F analysis. Second, we perform a deep fundamental analysis. Third, we apply and we analyze and look for the possibility to use our structured value purchase methods. And finally, fourth, we apply our portfolio construction philosophy, which includes considerations like the Kelly criterion, where we optimize our position sizing and capital allocation practices. So we have high levels of concentration because we have high levels of conviction. And our decisions are based on incredibly deep research. We optimize the level of diversification, and we do not make any expensive attempts to reduce short-term volatility. This is how the world works if you want to outperform. You accept short-term volatility due to your concentration that will allow you to achieve the long-term market-beating returns. So here, in step one, our 13F analysis, for example, tracks the holdings of nearly 100 world-class long-term hedge funds. And any firm with more than $100 million in assets is obligated to report their US holdings to the SEC each quarter. So we can easily analyze what Admiral investors are buying and selling. And it gives us a huge performance advantage. It's valuable to know, for example, that Dan Loeb just bought Disney and that Seth Klarman's buying Amazon. And Using some Python scripts, we've now automated what used to be a multi-day analysis each quarter to obtain great insight into portfolios of these leading investment participants. Many other funds and retail investors certainly set up screeners to identify cheap companies based on maybe ratios or fundamental factors. And that's typically better than nothing, but it is far inferior than our own method because the results from a screen will contain many false positives and it will reject false negatives. So a firm that screens cheap just can have hidden problems, and rejecting opportunities can have maybe there's a unique accounting attribute with a very strong firm. So our approach serves us better because we can avoid more errors, and it quickly narrows down 10,000 potential investment opportunities to a few hundred firms that are more likely to have the promising characteristics and deliver outstanding results. So our fundamental analysis begins with understanding the financial statements, all of the public reporting, but further, it includes our co-priorities framework that I've shown here. We're looking for superior business models, superior management teams, and extraordinary value. So this is an expansion of the Graham investment philosophies, which are based in accounting, to incorporate the Phil Fisher methods of owning exceptional businesses. And in step 3 here, we show another significant advantage, a true differentiator for our firm. We are using structured products like selling puts as a tool to purchase our shares for below market prices. We have developed this method of paying less than a retail investor for over 2 decades, and it provides an enormous price advantage and performance advantage. You've heard me talk about it for years. We call this unique buying approach structured value. So while it's clear that paying less, we have the more likely outcome of an outperformance than a traditional buy and hold strategy, most other professionals are not doing this. Warren Buffett actually will do this from time to time, but most funds don't recognize this advantage. In fact, Buffett's been buying Occidental Petroleum. It wouldn't surprise me, for example, if he's actually selling puts on Occidental and everybody else is trying to follow him by buying the stock and the stock price and paying a higher price for those shares. So I'm going to share some real portfolios examples to this approach in a moment to make it a little more clear. So finally, in step 4, once a firm has passed through all of these strict standards, we determine that then we look for the optimized portfolio allocation for the new holding. There aren't many opportunities that meet our requirements, which is why we are so pleased with the exceptional basket of compounders that make up most of our portfolio. We hold extraordinary businesses with exceptional management teams that we bought for very inexpensive prices that continue compounding. These firms have diverse characteristics in their businesses, ranging from their size, their industry, their regions, and with very different sources of revenue. Dando, for example, is our ownership of the 30 million book value India-focused hedge fund. We're not invested in the fund, we own the GP business that manages the fund. So indirectly, a great year in India will be a great year for us. Thales includes a basket of successful firms trading on the Borsa exchange in Istanbul. We built this separate entity to allow us to navigate the Turkish legal requirements and put capital into what is currently the cheapest market in the world. At Peterson Funds, we use this external product that we've built in our portfolio free of any management or performance fees. And while Daily Journal is a US-based small market cap courtroom software solution firm, which is earning tax-based revenues from states and countries, internally, Charlie Munger is managing a $350 million equity portfolio for no fees. So who wouldn't want that? But I'm getting ahead of myself. So let's begin with the list of our infinite compounders. This core group of holding makes up nearly 80% of our portfolio. In fact, Berkshire, Seritage, and HanesBrands are moving up so quickly that they've now grown to 50% of our AUM, and the growth will continue. All of these businesses have extraordinary management teams with strong capital allocation skills and owner-based mindsets. They prioritize things at these firms, actions that will increase intrinsic value per share. The companies have great business models and a variety of competitive advantages and pricing power, and they are all cheap and growing today. This means our portfolio is packed with asymmetry and parabolic potential. They have limited downside because they are strong, inexpensive, growing firms, and they have significant organic business potential that will continue to push their stock up. So one characteristic that I find particularly attractive is off financial statement value, because it's a secret that can be revealed sometime in the future, causing headlines and making big stock price gains. So these firms all exhibit tremendous off financial statement value, from the secret hidden revenue at Daily Journal to the many competitive advantages like high quality capital allocation capability by many at Berkshire Hathaway. These items don't appear on the balance sheet. There isn't a line item that gives credit to skilled, passionate management. But ultimately, these advantages will flow into earnings, and the stock prices will climb to reflect the success of these businesses. We expect very satisfactory returns from each of these holdings individually because of the enormous asymmetry potential in the aspects of these businesses. And so, as you know, we try not to discuss the current holdings publicly because it creates this commitment and consistency bias, but I will provide some interesting observations on a few. First, quickly, Berkshire is doing very well. Of course, it has an impeccable business model and exemplary management teams throughout the entire organization, but they've been also rapidly buying back their stock because Buffett himself clearly understands how cheap the shares are today relative to their intrinsic value. And in 2019, I disclosed a simplified model and our expectations for the market cap on the right here in 2030 of 1.7 trillion. And some very intelligent people pushed back. They suggest that this level of growth is impossible, yet these 2030 figures here remain unchanged since our prediction in 2019, and I remain confident that the shares will reach that level and maybe even past that 2030 estimate. So in the simple table, we have the sum of three parts. The cash, it's just cash. They have a large marketable, the market value of the market investment portfolio. And we've removed here the deferred capital gain tax, even though it's a liability that for a number of reasons they may never have to actually pay. And a multiple on the growing earnings from over 100 independent, wholly owned subsidiaries like Mid-America Energy, NetJets, and Burlington Northern. So as of last week, you can see the middle of the column where it says value today. There's 100 billion in cash, 250 billion in equity portfolio net of all tax, and the value of their operating business of 540 billion. So this suggests 900 billion in value today, which is a 30% upside to today's price, and it is growing, which is why Buffett is spending tens of billions each year buying back Berkshire stock. So we are very fortunate to own this inexpensive, growing, super high quality firm. But of course, that's not all. Again, we don't pay New York Stock Exchange prices for our shares. We pay less, and we pay less than all investors are paying to buy the same exact investment using our structured value method to purchase the stock. Since the inception of this fund, we've been strategically accumulating shares in Berkshire through the sale of puts that we use as a tool to get paid before someone puts their shares into our portfolio. So in Q2 of 2020, over 2 years ago, when during the pandemic, when Berkshire's price fell to a completely irrational level, we immediately sold puts and started picking up premium and committing to buy these shares for $170. We earned through this process a fair amount of premiums, about $500,000, and that's illustrated here in step one. But we also needed to account for the unique period that we were in at the start of the pandemic. So as the unprecedented stimulus began flowing directly into the bank accounts in the US, the markets began moving up very quickly as people deployed their new cash into equities. We recognized that there was very little chance that we would have access to these shares at these prices in 2022. Berkshire's price was going to basically be far higher than 170 when they expired. So in step two, we used most of our put premium to buy in the money calls with $170 strike. By using those premiums to purchase the calls, they ultimately cost us zero. We paid nothing. In fact, we had some excess premium. So we obtained the calls and cash for free. And in step three, you'll see that the calls recently expired this June. And we finally exercised our right to purchase the shares of Berkshire for $170 when the market price of the company was $300. So it's an extraordinary result. You should be very pleased. The actions we took in 2020 were free, and our first cash outflow was less than 2 months ago. We spent $170 a share for stock selling on the New York Stock Exchange for $300, and we have substantial upside from here. Next, I will share some excellent results from Seritage Growth Properties. This has been a highly controversial position, and it is really misunderstood. The shares today are selling for around $13 a share, and as I will explain, they are clearly worth about $27. And they can appreciate to that level quite quickly. Further, I will show you that by selling puts over a 2-year period to enter our position, we now have over 0.5% of this entire business. We own 0.5% of Seritage. And after all of the premiums we received, our net cost has been whittled away to just $6.57 a share. Seritage Growth Properties owns and leases and is now liquidating 150 remaining ex-Sears mall anchor and standalone stores that were spun off prior to the Sears bankruptcy. Some of these properties are not worth much. We know that. Others are in ideal locations like Santa Monica, California, Redmond, Washington, Dallas, Texas. The only reason that we've been able to hold on to this stock so confidently is because we did the work to understand the value of each property. Years ago, we began an extensive valuation analysis of every single one of their original 212 properties across America. We visited many malls in person. We visited every mall on Google Maps. We called mall management offices on site. We talked to local brokers. We used CBRE data and online tools to understand the value for every square foot of these properties. And last November, I met with the ex-CFO, Amanda Lombard, who is able to confirm our overly conservative estimate of some of these major properties. So how long does this type of deep analysis take? It isn't easy. Each property is unique. And with everything involved and all of the moving parts, I would estimate it's about 1,000 hours. So we can be confident in our conviction because we have the information that nobody else has. And we monetize this information by buying stock through the sale of puts during dips rather than panicking and selling like many others. So I will show you an example of one of their 5 premier properties outside Fort Lauderdale called Aventura to give you a sense of how we do our analysis. So Seritage has redeveloped this Sears footprint into 215,000 square feet, of which 75% is in contract for long-term leases. And at the bottom, we've calculated average rent revenues of $100 per square foot and net operating income of $65 per square foot. So CBRE publishes regional local cap rates on different property types, and they've observed a Fort Lauderdale suburb retail business is selling for a cap rate of 5 to 5.75. So we're using an even more conservative cap rate of 6 in our calculation on this property. And in blue, I've even done the math for you. They earned $65 in operating income on each of the 160,000 square feet that's currently in lease contracts. And if we divide that by 0.06 to account for the cap rate, we can expect this property to be sold for around $170 million and maybe more. And this is conservative. So Seritage has changed directions, and it's in the process of liquidating everything to maximize shareholder value. And they have stated publicly their expectations to make distributions of between $18.50 and $29 to every shareholder over the next 24 to 36 months. And our modestly sized fund has managed to accumulate 0.5% of this whole company. It required about 10% of our capital this year, and the position has already grown to over 20% of our portfolio. So let me show you the NAV estimates for each of our 5 property types. They categorize properties as premier mixed use, residential, multi-tenant retail, et cetera. And through our property by property analysis, we understand them to be conservatively worth about $2.9 billion, including cash. So after they cover their debt, which is actually to Berkshire, of $1.4 billion, the stockholders are left with $1.5 billion to divide up and distribute to the 56 million shares. By our calculation, $27 per share is reasonable, and management has provided these estimates of $18.50 to $29 per share, and they have no incentive to exaggerate those numbers because they want a reputation of being successful. So they are presenting figures that they expect to exceed. Today, the stock is available for 13. So without using structured value, I fully expect a shareholder to pay out twice as much over the next 8 to 12 quarters. It's really remarkable. But of course, that's not how we operate in the market, and that's more than we paid for our shares. We sold puts and obtained millions in premiums to buy the stock from others before we bought the stock really from others. And by the way, it's worth noting Warren Buffett bought a personal position in this stock and paid $35 per share, 5% of the company. Through selling puts and indirectly purchasing our shares, they cost us just $6.57. And furthermore, we didn't actually put any of our cash out until just this year. So we've already made 100% on Seritage. We expect them to deliver 200% of today's stock price in cash to us over the next 8 to 12 quarters as they liquidate this business. So this is now a 20% holding in our portfolio. So when it doubles, the whole firm is going to earn 20% from a single position. And we're likely to receive basically 3 to 4 times our initial investment in cash. The funds went out in 2022, and the cash is going to come back in 2024, 2025. So we will continue to monitor the developments here very closely. As they wind this down, it is a very interesting time because we get to compare our estimates with what they are selling for. And we are finding ourselves to be quite conservative. Finally, let's talk briefly about one more compounder, Daily Journal Co. We have done more research on Daily Journal Co. than anyone else in the world outside of the company. There is enormous financial statement value. It has exceptional management. It is a wonderful business model, and it's completely misunderstood and totally undervalued. I have posted several videos on YouTube. We have a YouTube channel. You can find the videos there that explain our thesis and how we researched this for years. So I'll be brief here, but I encourage you to watch those if you do want a little more detail. In brief, after attending many years of the annual meeting in Los Angeles to see Munger speak, he began mentioning software in his opening remarks in just a word or two. But nobody I could find, I know a lot of people in that room, nobody had any idea what they were building. So I found a customer training conference in Utah. I took a flight, I booked a room, and I proceeded to converse with the customers in the lobby over a 3-day period. And we obtained incredible insight Daily Journal, a small newspaper firm in Los Angeles, was not a newspaper company at all. They were providing court software solutions for the justice system on a 10-year contracts, gaining 10-year contracts all across America. Further, I learned that the RFP process and the technology development process for each courthouse was taking 4 to 7 years to implement, and they were not billing their customers until post go live. That means that Daily Journal had a pipeline of large sticky revenue that was completely missing from their financial statements. And nobody knew anything about it. They just hadn't billed the customer. And further, while the revenue was yet to arrive, the financial statements did include all of the embedded costs of this startup-like operation. So you can't get a very good idea about what's going to happen by just reading the financial statements. This entity would not screen well at all. But similar to the hard work we did on valuing all the properties at Seritage, we started on the West Coast, and for months we studied the 3,300 counties across America. We read city council meeting minutes. We read, the request for proposals, anything we could find that would mentioning Daily Journal or one of their products like eSuites. That would suggest that a county might have a relationship with Daily Journal. And we found through this method over 100 contracts. We learned at the time that LA owed them $5 million, Austin owed them $1 million, and we found a contract in Australia for $89 million. And that's just the beginning. So to show you how inexpensive this high quality firm is, I'm going to quickly remind you of the 3 parts of this micro cap. It's a $370 million business that's been run by Charlie Munger for 43 years and his 300 carefully handpicked employees. There's a newspaper business and it makes money. The revenue's around 11 million a year. We value it at 0 just to be overly conservative. There's an equity portfolio run by Charlie Munger with a value of about $350 million. And if we add up the cash and real estate and subtract this very unique debt, like the deferred capital gains tax that has 0 interest and no maturity, or their margin loan, which has a rate of 2.25%, the net assets here are $220 million. So this leaves us with a debt-free software entity earning tens of millions in sticky recurring revenue that make up the remainder of this portfolio. So in the videos online, I explain in detail that Daily Journal Co. can grow their revenues to 100 million by the year 2030, and with a very sticky revenue from these long contracts, these governmental contracts. And that the Journal Technology subsidiary alone could be worth $1 billion or more. So we're incredibly fortunate to have this exceptional holding as one of our core compounders. And I'm pleased to say that today we also own 0.5% of this business. We own 0.5% of the equity portfolio, of the software, and of the newspapers. And so I'll show you their portfolio for a moment, and then I'm going to elaborate on one aspect that I think is confusing a few people at the moment. So this is the current stock portfolio inside of Daily Journal. And if you think about it for a moment, with their cash, real estate, and assets managed by Munger, DJCO is the portfolio inside of DJCO is now larger than the market cap of the entire firm. How can this be? I mean, oh, they have debt. I mean, that's the common consideration. Well, they have this debt that's being inflated out of existence. The weighted average cost of their debt is 1.1%. They pay less than $2 million annually in interest, and the dividends from their investment portfolio service the entire debt obligation. So it's extraordinary how cheap this company trades right now. Some of you may have read the book 100 Baggers, and it talks very specifically about firms that have the ability to compound and earn investors 100 times their original investment. It would turn $10,000 into $1 million. DJCO is already almost a 200 bagger, and it's currently selling for below its liquidation value. Now, I mentioned that you can't really understand what's happening just by looking at the financial statements. What people are missing about the business is that the revenue right now appears slower than reality because they have strategically discontinued the Justware product line. They are encouraging customers to upgrade from Justware to their eSuite products. And this action temporarily eliminates 6 to 8 million in annual revenues. And Journal Technologies is only earning about 34 million. So if they deliver anything close to 34 million this year, that would suggest that the eSuite product is on track for 20% plus growth, and this can accelerate. So don't think of last year's revenue as 34 million. The current product line was earning about 26 to 28. So you can figure out better growth estimates if you're looking at a consistent set of products. Finally, I will mention that Charlie Munger recently appointed a new CEO, Stephen Myhill-Jones. I had the honor of meeting with him over a Zoom call this summer. And in fact, I was told that it was the first meeting with an outside shareholder after he joined the firm. So he is obviously a fantastic leader, very smart and motivated. And Charlie has called him whip smart, full of energy, exactly the kind of leader we need at Daily Journal and Journal Technologies to take our business into the future. And as a side note, as Steve and I were being introduced via email, I was quite honored that he responded saying, yes, I'm familiar with Matthew Peterson's report. Indeed, it was a resource that helped inform my decision to join Daily Journal some months back. So I'm really pleased to see that our research is providing this type of unexpected value for our holdings. It's phenomenal. So now that brings us to the last section of these slides. And it's a very exciting and truly differentiating aspect of this fund, where we have begun earning incredible returns on our consistently large cash holdings. So I have been honing the structured value stock purchase strategy for nearly 20 years. And since the inception of this fund, this has allowed us to build into our long-term compounders for below market prices, giving us world-class returns. One challenge is that as a result, we always have a lot of cash. The cash often sits idle for quarters and years, and it's held to purchase the intended stock when our short put contracts expire, but cash earns zero. And well, so we sit waiting for expiration with cash earning zero. I guess today you might be able to earn 2.6% in a treasury. So we earn this great premium by selling the put contract. But if we could obtain a sizable yield on our cash while we wait to buy the stock, we can perform far better. So for a decade, I have been looking for potential solutions for our cash problem. But until recently, it's always been earning nothing. In fact, 5 years ago in Switzerland, I spoke at the ValueX conference hosted by Guy Spear on some pair trade arbitrage opportunities that I had found for value funds while looking for higher yielding uses of our cash. And in the talk, I explained the challenges of implementing these in practice. Most of the opportunities were failing due to, in fact, they were all failing due to timing, due to liquidity, bid-ask spread, scaling issues. And I share this because it's important to recognize before we jump into this, that we have analyzed hundreds of possibilities that don't work to finally discover one that does. And the partners of this firm are going to make a fortune. We call this allocation structured dividend capture because we use structured products to capture high dividends in the market over a day or two and then immediately go back to cash. We treat this basket of small, we treat this as a basket of small positions, and we treat it as one holding inside of the portfolio, but It's really a cash alternative that's just providing enormous gains. So we start by collecting a premium, and pardon me, oh, sorry. I am experiencing there we are. So we start by collecting a premium. And it's right there on the top line. As we write an out of the money put for a good firm that expires days before a large dividend payment, we keep this premium and are possibly put the shares for as short as a week where we capture a large dividend. And then we exit that Friday collecting a premium on a covered call. So over about 15 days, we pick up a put premium, a stock dividend, and a call premium, and are left back in cash. In fact, we have a lot more cash than we started with. Further, we're doing this with dozens of securities at the same time. So any single holding may only account for 1% of the portfolio for a short period. So even if the share declines, it's not going to cause any significant harm or to the performance of the fund. Finally, our 13F analysis guides our decision to select these opportunities from a pool of 400 or 500 stocks that are held by the top fund managers in the world. One major challenge is that it required months of data analysis. How do we know each quarter when and where to allocate capital to capture the maximum yield? How can we maximize this approach? So we built software with Python to automate our analysis. This flow diagram illustrates the functionality of our software solution we built to aid our analysis. We have reduced the time required from many weeks each quarter to just a few hours. The software we built takes data in from 3 different subscriber databases. It creates our 13F superset of SEC data. It then breaks down financial metrics based on financial statement fundamentals so we can eliminate any firms with problems. And then the software recommends an ideal capital flow and Gantt chart that maximizes the IRR on our cash on an annualized basis. So let me provide you with some real examples from last quarter to help clarify. So once we've identified this capital flow, we start putting our cash to work. In this first example, we show results from the transactions around Lumen Technologies. The blue line indicates time moving from left to right. And we began by selling a $12 strike put on Lumen and receive an 89-cent dividend or an 8% premium, giving us a net cost for the shares of $11.11. We then hold the shares across the ex-dividend date on May 27th and receive 25 cents or 2.3%. Finally, we attempt to exit with a $12 strike call, but the stock price was under that strike on June 3rd, but it's not a problem. We just immediately sell a call expiring the following week. And with a strike of 11, we picked up another 85 cents at expiration. So this means on our net cost of $11.11, we earn a 25-cent dividend, a call premium of 21 cents, and 85 cents. And we also lost 11 cents between our price of $11.11 and what we sold it for, 11. So this is a real example. As markets were collapsing during 51 days, as the shares fell 2.7%, we made 2.8% for an annualized gain, 21.8%. In a similar example, here is Icahn Enterprises. Here we have a $55 strike put, and we picked up $4.10 for our net cost of $50. $2.90. And you can see we picked up an 8% premium on that put contract. We then received a 3.9% dividend of $2. And then we write a $50 strike call and exit for $2 and earn another 3.9%. Again, shares were just below 50. So we wrote a call for the next available expiration and earned a final $1.20, 2.4 additional percent from that call. But down at the bottom, you can see we adjust our strike price by $5 to exit the stock. And the stock declined 4%, yet we earned 8.5% over this time frame, which is a 27.4% compounded annualized return. Okay. Finally, I'm going to show you a loss because not every situation, our basket is expected to be positive. HanesBrands fell 7.6% during our brief holding period. We received 3 payments: a put premium for 70 cents, a dividend of 15 cents, and a call premium for 40 cents. And our call strike price was below the put strike price because the price had fallen and we want to exit. So in this scenario, while the shares fell 7.6%, we experienced a decline of 1.9%. This, of course, is a very tiny holding, but because of the 3 incoming cash flows, they offset the full equity decline. Okay, how good can this get? Here is a forward-looking capital flow diagram that starts this upcoming September with an allocation to Dividend Energy. It concludes with the allocation to Lumen. So take your screenshots now. This is what you receive when you start lining up the dividend dates and grabbing large dividends using structured value. So here we receive 21 premiums and dividend payments on these 7 securities over just a 3-month period. And this is about to happen. It's forward-looking. The potential exists to create a 34% gain on our cash in 3 months. It's phenomenal. In practice, we use a basket of multiple opportunities, but there's a really simplified version. A single track of capital can take. You don't need to, every position here does not need to work perfectly to achieve outstanding results. So take a quick look. We'll walk through this here. We start the process selling a put on Dividend Energy and earn 7.5% from the 3 incoming payments of the put premium, the dividend, the call premium. Then we move to US Bank, JP Morgan. By the time we've exited enterprise products, we will be up 23%. After Wells Fargo, HanesBrands, and Lumen, you'll see down at the bottom right, we'll turn $1 million into $1.3 million in 3 months. So how could this exist? I mean, what and why does it exist? This is a strange anomaly. Most market participants are not using the products for these purposes. Puts are used to protect the portfolio, not to be capturing dividends. So these prices look correct to them. They just look wrong to us because we're using them for a different purpose. And we've estimated that we can push at least 30 million through this strategy because it's hard. It might be hard to get a lot higher because of volume constraints, but 30 million is nothing for a big bank or investment institution. So they can't do this. Not only are they totally unaware that the situation would exist, but earning 15% or even 50% on 30 million is totally immaterial for their earnings. And so they just leave the space alone. And further, retail investors typically lack the knowledge and capability to execute this effectively. Now, I'm sure some of you want to test this on your own and you'll be successful. And I would be delighted to hear your stories. But this space is wide open and we are just printing money. By the way, I want to point out this doesn't suggest that our fund size would be 30 million because 80% of the capital is already allocated to the long-term compounders. We can operate a fund with hundreds of millions of dollars using just our idle cash to rip these premiums and dividends out of the market. So over this past summer, we began a very exciting collaboration with the computer science professor, Dr. Sid Krishnan, and his graduate student, Lavanya. We recently completed 25 years of backtesting. So we could examine results during periods like the Asian crisis, dot-com collapse, 9/11, financial crisis, pandemic, and the current inflationary and rising interest rate environment. And the results are astonishing. Since 1997, over a 25-year period, executing the strategy would have turned $1 million into $27 million. Compared to our benchmark, the gray line, the formidable S&P 500, that would have only grown to $10 million. So this provides us with a nearly 15% annualized return that is outperforming the gains in the S&P 500 by 50% a year. Impressively, we have 100 quarters of data, and the results there are only 4 quarters out of 100 with a small net loss. And we have just gotten started. With this back testing capability, we can now test minor adjustments over long periods of time, like consistently writing a slightly in the money contract versus an out of the money contract. One test we ran here on the top right is the results from a 13F output versus the global set of securities versus not using any options at all to buy and sell the stock. And the graph shows over the shorter period of 7 years where the 13Fs are starting to outperform the global securities. I do expect that they will outperform over time. The blue upward sloping line at the bottom shows results from grabbing dividends without using structured products as expected. And of course, we completely outperform that. I want to point out one last aspect that I forgot, which is if you look here without our back testing, the first 5 years on this chart, I think you'll notice it would be very hard for us to tell if we had a winning strategy. We wouldn't be confident because, for a while, the S&P, year 3, the S&P was still ahead of this particular strategy. But through back testing, we can see that the long-term nature of this is going to absolutely crush the market expectations. And that's exactly what we're testing with these new tests. So we can see that 13Fs are starting to outperform the global securities. The blue upward sloping line, of course, is not even outperforming the S&P 500. And finally, on the bottom, I've illustrated our intentions of producing Monte Carlo simulations so we can look forward with statistical confidence, as well as looking backward. If we run millions of simulated paths through the model with price fluctuations that stress our variables, we can confidently create some expected returns and the standard deviations of that outcome. So let me reassure everyone, we are a long-term value-based fund with a concentrated portfolio of exceptional businesses run by extraordinary management teams that are selling for deep discounts. They're growing intrinsic value. None of that has changed at all. We also have used the structured value approach, selling puts as a tool to buy stock, since the inception of this fund. We have simply found a way to pull large amounts of profit out of the market while our cash is sitting idle because it's allocated to the future purchase of these compounders. So today, we have far more opportunities than capital. We are just a small firm. We're not yet a well-known entity. But I strongly encourage you to trust us with more of your capital on October 1st. We are going to put it to work immediately, and the future is very promising. So I would like to take a moment here and just extend an enormous thank you to our team. We now have 3 interns, Andrew, Richard, and Grinch, who are all brilliant, ethical, and extremely hardworking. We have a lot of fun. We've basically been working about 18-hour days for the last few weeks, and they're really a pleasure to work with. These 3 are extremely well prepared for any career path of their choice. We also want to thank our service providers, Josh and Catherine at Eulish and Associates, and our auditors at Spicer Jeffries. We quite literally can't operate without them. And they've been with us since the inception of this fund, and we hope to continue working with these teams for many years to come. Finally, our sincere appreciation goes out to Sid, Krishnan, and Mahalavana. Our collaboration is truly opening great areas of opportunity and importance. It's such a pleasure working with these two on these efforts. They bring this academic mindset. They're helping us to combine finance with technology to produce something that's much larger than the sum of the parts. And Dr. Krishnan is here with us today, and he's going to now say a few words before we move into the Q&A portion of this meeting. So Danielle, with that, I will turn the meeting back over to you.
Wonderful, thank you. It's my pleasure to introduce Dr. Siddharth Krishnan.